Welcome to Market Monday from the investment team in the trust department at the First National Bank. We'll start things off today with all of the economic reports on deck over the next couple of weeks and what those implications might be. We will look at current states and potential paths forward for equities and the fixed income markets as well, and finish off with the long-term view and what are the implications of all of this stuff for your portfolio. So going into it today, this morning earlier, we already got numbers on the manufacturing and the purchasing managers index, which came in slightly weaker than expected. That actually suggests that, maybe the outlook is a little bit more sour than what analyst consensus was. As we move in to the week, we're going to get factory orders and durable goods, and these are important. When you look at factory orders that were up 4.3% in the prior period, looking to be, for this one, the analyst consensus is down 3.2%. That's not really a great signal for demand in the future. And then when we see a 6.3% decline, followed by, that being unchanged and not being revised up, we probably don't look at that as being very bullish for the economy. Going down, we'll get some labor markets information. Some more sentiment. All of these purchasing managers index type numbers are sentiment indicators, and sentiment is a good thing when you're looking forward and trying to forecast what demand is going to be like. When investors are sour on the future, and when purchasing managers in particular are sour, as to what the future looks like, that tends to augur poor demand conditions going forward. And these numbers are not good by any stretch of the imagination. These are low numbers for these indices. Looking at the trade balance, that number has jumped up in importance recently with all of the tariffs and everything that's been going on. But by and large, we're really looking at what's going on in the labor market. Non-farm payrolls are coming Friday morning. An expectation is for 128,000. That's one of the weakest expected numbers that we've seen in quite some time. That number was well above 200,000 for most of last year, and even a couple of times this number was reported in this year. As we see a slowing labor market, decelerating, I should say, it's not actually slowing. It begs the question how healthy the economy is, and we're watching that. The unemployment rate's expected to be about unchanged at 4.2%. That number is actually below. In other words, it's actually signaling strength because it's below the long-term expected sustainable number of 5% unemployment. Moving into wholesale trade inventories, there's no forecast here yet. But, if we're starting to see sales decrease, and we're starting to see, relative to what they were, and we're starting to see inventories rise, that's a signal that the economy is actually slowing. The wheels of commerce are slowing. The big numbers coming up over the next couple of weeks probably are the CPI and the PPI, so Consumer Price Index and Producer Price Index. And when we look at these, they're expected to show a slight bump when you take out food and energy. Those prices on a month-over-month basis are expected to show a 0.1% increase, and on the year-over-year basis, a 0.2% increase on this one. So when you look at the numbers without food and energy, that number's a lot closer to what the Federal Reserve is looking at when it looks at, trying to gauge its effectiveness in stemming inflation. And when we see the numbers that signal inflation starting to creep up, we're not in a really great shape. And then this also has implications for what's going on with corporate profit margins, because if we proxy consumer prices as sales prices, and those have been rising by, say, 0.3, and producer price indexes now, which actually declined last time this number came out, rise by 0.2, that suggests that profit margins are starting to shrink at corporations. That could have implications for stock market pricing. So we're watching that as well. And then we round things out with the sentiment indicators that show us forward-looking guidance. But again, we don't have forecasts for this stuff. So what are all the implications? We're seeing pretty strong signs that the economy is at least decelerating. It actually contracted in the first quarter, and that's expected to continue through second quarter. We'll figure that out here shortly when those numbers get reported, but we're expecting to see that it contracted again in the second quarter. And what does that mean? That would technically be a recession by most people's definition, although there are some subjective elements by the National Bureau of Economic Research before they actually call something a recession. So we don't know that we're in one, but there's a probability there, and it's not insignificant that we are. We also are seeing signs that inflation is kicking back up, which is problematic when the Federal Reserve has a dual mandate to control inflation and yet maintain stability in the economy and stable employment. So balancing those two, they don't have many tools available to them in the conditions where inflation is rising at the same time the economy is slowing. And that brings to mind periods like the 1970s, that term stagflation, which has been bandied about quite a bit, including by myself. And it's going to be interesting to see how the Fed moves going forward. Their hands are somewhat tied using traditional policy measures when conditions are like this. So we'll see what happens as things move on. But moving into equity prices, the S&P, this is worth noting. I want to first compare and contrast something. This is a chart of 1 year of the Standard & Poor's 500, our bellwether index here in the States. And we'll notice that, yes, everything got really crazy at the end of February and through the end of March, through mid-April or early April, before stabilizing. And we have yet to recoup and reclaim the all-time high in the S&P 500 index. If you go to the wider world, this is the MSCI EAFE index, which contains, everything except the United States. And this had the same problematic, features in the early part of the year. February was good for this index. March came bad, and then it really took a dive in April. But that's already trading up at new highs, and it looks like it's consolidating there and getting ready to move higher. So why is there a disconnect? Well, all of this tariff business that's going on somewhat plays into it, and the fact that there are probably the period of the past, say, 15 years or so where the U.S. stock market has been the world leader in returns, that might be coming to a close. There might be some strong opportunities over in Europe and in Asia, and we've actually made some adjustments accordingly. When we look at volatility, things got extremely volatile earlier this year. This is a level that we haven't seen since, panic at the end of last year or toward the end of last year, and this periodically happens. Volatility is low, and then it spikes, and low, and then it really spikes, and so on. So we're not complacent with things down here. We got to keep an eye out because there are a lot of potential catalysts that still are out there that could spook the market. But when we go back over, let's say 20 years, we're not as concerned. And this is what we're talking about when we say we want to be long-term investors and not as concerned with the short-term bouts of volatility. Again, here's 2008's great financial crisis, the shutdown in 2020 and the bear market of 2022, and then the most recent drawdown, which, these are significant, but over time, so long as you maintained a long-term disciplined outlook, you were doing okay. Moving into interest rates, you'll see this is the U.S. Treasury yield curve. And when we talk about the Treasury yield curve, short-term rates signal, how investors feel about economic conditions and what the potential risks are and, what monetary policy is going to be like. And so rates over the past year year and a half or so, have come down dramatically on the short end of the curve as, investors, the large investors that dominate the bond market, see that the Fed's having to lower rates to become more accommodative, to try to stimulate the economy a little bit. And so it's essentially telling us, investors see the monetary policy remaining, rather accommodative for some time. However, as we get further out here on the curve, this is going up rather sharply. And as a result, what we see here is that's inflation expectations. That's the risk premium associated with owning a treasury bond. It's really the only risk premium, is the erosion of purchasing power over time due to inflation. So if you look at a 20-year bond yield and that's gone up by 81 basis points over the last year and a half and 20 over the past month, that's telling us that investors see higher inflation over longer periods as being increasingly a large risk. A lot of investors too are thinking that there's also kind of this idea that the United States isn't as safe of a venue as it used to be, and we're going to talk about that. First of all, we don't think that's true, but when you look at what's happening in the currencies, that suggests that large investors are in fact moving money out of the dollar and into other currencies. The dollar index. This index is how typically investors and media and so forth are reporting about the strength of the dollar, but there's a problem with this. First of all, this chart does not look great. It looks like the dollar is weakening and heading to potentially make new lows. But the problem in using the DXY index as a proxy is this is about 58% just the euro versus the dollar cross. So in essence, all this indicator is doing is measuring how we're performing against the euro, and everything else is kind of tangential to it. So what we do here is we look at an equal weighted index that balances the US dollar against all other 7 of the major currencies, and what you see here is a pretty different picture. I'm going to bring this one back just for a second, the DXY, which shows everything looking very low. And then this is what it looks like relative to an equally weighted basket of, the Swiss franc, the Japanese yen, the Aussie dollar, the Kiwi, New Zealand's dollar, the Canadian dollar, the Great British pound, and so forth. So when we are looking at this looks like the dollar is actually strengthening a bit and maybe holding steady at the place where it's at. And if you decompose that into the individual currencies, the strongest performer since April 2nd, which was when all of the tariffs were announced, is the Swiss franc. And as a result, this is telling us that investors are taking a flight to safety trade. And it used to be that this currency and the United States dollar were considered to be, along with the Japanese yen, were considered to be the safe currencies. And you would see when a risk-off, quote-unquote, move happened, when investors were seeking that safety trade, they would move into those currencies, the yen, the franc, and the dollar, and then they would move away from the speculative currencies, the Australian dollar, the New Zealand dollar, the Canadian dollar. But that's not happening right now. Those are relatively stable. And the US dollar is actually the weakest performer of the bunch when you measure against all of them. So what that tells us is money has been flowing out a bit. Does that have big implications, to our monetary policy or to our fiscal policy? At this point, probably not, but we want to see some stability return to the dollar. And moving into A-rated corporate bonds, this yields are up pretty dramatically as well. And the two risk factors here for corporate bonds, you have the same risk factor, inflation. That's one of them, erosion of purchasing power due to inflation. But another risk factor that's priced into corporate bonds is potential default risk. And what we're seeing here is, this is moving up at a pretty nice rate, and it's continuing to move up. Now when we look at interest rates, we want to be thinking about that as that is the cost of money for any given credit quality of a borrower. So in the case of the United States government, that's basically considered to be a default-free asset. It's risk-free, the highest quality. And then you have very high-quality corporations that are not at all likely to default. They're going to pay a higher price for money to borrow it. But overall, if you're a fixed income investor, this is great right now. 4.6% on 5-year paper, 5.2% on 10-year paper, and if you go out, 25 years, you're getting close to 6% yields. And income investors and defensive investors that want to diversify across asset classes and own bonds to balance volatility in their stock portfolio are getting paid to do that. So these are attractive yields by recent historical standards, and that outlook remains pretty strong. With the outlook that inflation might be ticking up, rates do have the potential to move higher. We are thinking that we may see some waves of higher rates over the next several years or decade. So we're keeping an eye on rates, but overall they're pretty good right now, and there's potential for them to get a little bit better as this ongoing situation, the world resetting to new trade boundaries and rules of engagement, so to speak, as long as that process continues. And that process is probably going to take at least a year, if not 2 or 3. So hope you found this video useful and informative. We're here to talk. If you have questions about your portfolio, if you have implications about, wondering what the implications are for that or your investment plans, feel free to reach out to us. We love to talk about it. Thanks. Have a great day.